How do the IMF special drawing rights, SDRs, work? Imagine a global piggy bank that helps countries in times of need. That's what special drawing rights are. They are an asset created by the International Monetary Fund to support international financial stability. SDRs are not actual money like dollars or euros. Instead, they are a potential claim on the currencies of IMF member countries. Think of them as a kind of international voucher that can be exchanged for hard currencies when needed. The value of an SDR is based on a basket of major currencies, including the United States dollar, euro, Chinese yuan, Japanese yen, and British pound sterling. The IMF introduced SDRs in 1969 because traditional reserves like gold and US dollars were running short. This was especially true during the Bretton Woods system, which fixed exchange rates to gold and dollars. When that system ended in the early 1970s, the value of SDRs shifted to being tied to this currency basket instead of gold or a single currency. Countries get SDRs based on their quota in the IMF. The larger a country's quota, the more SDRs it receives. These allocations are not loans, so countries do not owe anything back. Instead, SDRs act as a supplement to their existing reserves, giving them more flexibility to manage their economies. Countries can keep SDRs as part of their reserves or exchange them for freely usable currencies like dollars or euros. For example, if a country does not have enough foreign currency to pay for imports or debts, it can trade its SDRs with another IMF member willing to exchange them. This process provides liquidity, helping countries avoid financial crises. There is also an interest system tied to SDRs. Countries earn interest on the SDRs they hold and pay interest on their allocations. If they exchange SDRs for currencies, they pay net interest on the difference between what they received and what they used. Holding onto SDRs without exchanging them means no net cost because the interest earned cancels out the interest paid. In 2021, the IMF issued a large amount of SDRs, about $650 billion, to help countries deal with the economic impact of the COVID-19 pandemic. These allocations give countries extra resources to support health programs, social services, and manage external debts without increasing their borrowing. Overall, SDRs serve as an international reserve asset that boosts liquidity and stability in the global economy. They help countries manage external imbalances, reduce reliance on scarce reserves, and provide a flexible way to access foreign currencies when needed.